All right, welcome to Chapter 12 of the Walker book, which is on mutual funds, which is a little bit of an interesting thing to start now because one thing about mutual funds are they kind of invest in a little bit of everything. So, all the things we're going to be studying for the latter part of the semester stocks, bonds, real estate, things like that you'll find mutual funds that pretty much invest in those things. So, I think it would probably have made more sense for Walker and Walker to put this after the stocks and bonds chapters rather than before. However, it's where we are, so we'll just go ahead and continue with the order of the textbook, and maybe next year we'll fix that a little bit. But mutual funds are just simply put a way to diversify your investments without having to really know how to diversify your investments, for lack of a better term. So, mutual funds are investments in which individual investors pool their funds and pay a manager to invest in stocks and bonds and other things for them. And so, the nice thing about mutual funds are you can diversify without having as much money, and it pools your risk and allows an expert, somebody whose job it is to monitor the stock market, to follow the stock market, to oversee your assets rather than you having to follow the stock market like we're doing in our stock project, or rather than you having to follow the bond market for yourself. It's a lot easier and probably a lot better for most of us just to have somebody else who's good at that do that. And so in the 1980s, mutual funds gained a lot of popularity for a couple of reasons. Number one, the stock market was really taking off and people wanted to take advantage of that. Now, that became a self-fulfilling prophecy because as more people invest in the stock market, that means you have more buyers. When you have more buyers, you have more demand. When you have more demand, prices go up, right? And so over time, that interest in demand of the stock market pushed up stock prices, and we've had a few corrections, but for the most part, the trend in stock prices since the early 1980s has been up, and up for quite a while. So the key thing to understand about mutual funds is, let's think about our class. Instead of one person buying, say, stock in McDonald's, and another person buying stock in Apple, and another person buying stock in Amazon because those are the companies they know and that's all you can afford. If you're buying stock in Amazon, that's, or Google, that's $1,000+ a share. Well, if you're a typical investor like most people, you may not have $1,000 lying around, or you may not have the ability to invest in more than one share of, say, Google or Amazon. But if we all pooled our money together, let's say there are 30 of us, and we all throw in $1,000, now we have $30,000. And now you can buy a share of Amazon, you can buy a share of Google, you can buy a bunch of shares of Apple, and now you have a tech mutual fund. And essentially, what happens is when you buy in, you're putting more money in, and that money will be invested in the stocks that the mutual fund's already invested in. When you decide to cash out, when you sell the mutual fund, just like when you sell a stock, you will get paid based on your share of the value. So, if there's 30 of us, you would get 1/30th of whatever the price of Amazon is, or 1/30th of whatever the price of Apple is at that point. And so there are two types of mutual funds, open-ended and closed-ended. Open-ended mutual funds basically allow for constant investment, constantly new investors to come in, and they basically issue shares in the mutual fund based on the value. And this sounds a little bit esoteric, but essentially, let's say that you buy into a mutual fund. The 30 of us have invested in a mutual fund, and a 31st investor comes in. And so now they buy into it, and now there's an extra $1,000. So that extra $1,000 will get invested in, and now it'll be paid out to 31 shareholders instead of 30. And so that's how an open-ended fund works. If 5 more people come in, well, now we have 36 shareholders, but there's 5,000 extra dollars that's being invested as well. And so it's distributed equally to each shareholder when they cash out. And so Mutual funds have costs and fees. And one thing we look for is what we call a no-load fund, because no-load funds have no fees on the front end, purchase fees or redemption fees, fees in the back end. What purchase fees are is when you buy the mutual fund, you have to pay a fee up front to buy the fund. It might be 1 or 2%. A redemption fee is when you cash out. When you sell your share in the mutual fund and receive cash, they take a little bit off the top for a redemption fee. A no-load fund has neither one of those things. So the price of the fund then is based on the net asset value. So what are the total assets of the fund minus the total liabilities? Basically, think of it as what is the total amount of the stocks and bonds and everything? What's the total value of the stocks and bonds the fund owns minus whatever the costs are to operate the fund? Those are the liabilities. So the expense ratio is those costs. So the expenses often run up to 2.5%, and that's paying the fund manager to buy and sell the stocks on your behalf and to manage the fund. So that's really key. So the net asset value is really what you're looking for here, and that's the price of the mutual fund, is it's based on that. And again, it's the total assets of the fund minus the total fund's liabilities. Then you divide that by the number of outstanding shares, the number of shares that are out there. And so there's basically 6 different types of mutual funds. The most important and probably the most common are actively managed funds and index funds. Managed funds have a professional fund manager who's constantly looking for assets to buy and sell. Maybe if a stock's overvalued, they'll sell that stock and then take the funds that are received from that and invest them in maybe undervalued stocks. So they're constantly buying and selling stocks on your behalf and the behalf of the others who have bought into the fund. An index fund tries to imitate the well-known indexes. The Standard & Poor's 500 is one common index fund. As you'll see, S&P 500 index funds. Russell 2000 is another type of index. It tends to look at obviously 2,000 companies and tries to buy stock in each one of those. So an S&P 500 might have one share of each fund each stock in the Standard & Poor's 500 index. And again, the S&P 500 is 500 companies that represent kind of a swath of the stock market. And so they'll have one share of each company per se in that. And so each of these funds try to hold all the stocks in the same proportion. So that way, it's either one share or maybe they'll have invested $100 in each company or some $1,000 in each company or something like that. An exchange traded fund, generally, those are a little bit more esoteric. They're a little bit more like stocks. They're traded on the open market and bought and sold. Equity funds primarily focus on stock investments. And the one thing about equities is they'll tend to focus on some specific types. You may have a general equity fund that is looking at the overall stock market, buying and selling. Some are international funds. Some are energy funds. Some are tech funds. You see a lot of international equity funds. Those tend to be very popular because there's a little bit of risk, but not a ton of risk in them. Probably a little more risk internationally than you might get in a domestic funds. Bond funds obviously focus on buying bonds. Those are going to be a little bit more safe, a little less risky because there's not as much exposure to the stock market, which is a lot more volatile. Money market funds, generally have the lowest rate of return. They're kind of like money market accounts because they generally invest in short-term debt. So short-term bonds, essentially, we're talking about bonds that have terms of days or weeks or sometimes even overnight bonds. We call those commercial paper. And so money market funds tend to invest in those where they'll loan somebody, money for an evening, a business for money for an evening, and then it'll carry over to the next day. So you see all of these. Generally, your 401k or your retirement fund will probably have some menu of all of these in them, but especially equities, indexes, and managed funds, and maybe some bond funds as well to just give you some diversification. So what are the benefits of a mutual fund? Number one, you have a professional manager. You don't have to have a tremendous knowledge of the stock market, nor do you have to have tons of money to buy a bunch of different stocks. You have somebody whose job it is, their full-time job, to manage the stocks. Number two, you get a lot of diversification and variety. And one thing we've all said when it comes to investing is don't put all your eggs in one basket. Mutual funds allow you to not put all your eggs in one basket. They're easy to understand. They're easy to research. The initial investment is usually very low. We're going to look at that here in a minute. And there's some automatic investment as well. One thing that I do with my retirement account is I do what's called dollar cost averaging. And that's a really fancy way. And as one thing we say in economics, right? We take really simple things and make them complex. Here's what dollar cost averaging is. Putting in a set amount of money regularly at specific times, no matter the price of the asset, whether it's really high or really low. Let's say you put $100 a month into your mutual funds or into your retirement account. That's dollar cost averaging, because if your retirement accounts are really cheap like they are right now because the stock market's been going down here in 2020, then you just buy more stock with that $50 or that $100 you're putting in a month. If it's really expensive, well, you buy less. Hence the term dollar cost averaging. You're putting in a set amount of money each week, each month, even though the prices may be going up and down. And so you essentially mitigate your risk, because when the price is low, you buy more of something. When the price is high, you buy less, but you put the same amount of money in each time. One thing as well about the mutual funds is that any dividends they get or any money they make from the sale of stock, they reinvest right back into the fund. And so you can continue making money off of it. Record keeping is a little easier, and liquidity. You can sell out of a mutual fund. You can cash out of a mutual fund at any given time. Obviously, the risks, because you're paying a fund manager, the expenses are going to be higher than buying stock directly. And yes, in all investments, there is risk. There is a possibility of loss. So make sure you're doing your homework and researching. Okay. The price of the mutual fund is the cost of buying a share of the fund, and just like a stock price. And so what are the costs? Number one, management fees, load fees, and commissions. The management fee is how much you pay each time you buy new, each month you're invested in the fund. A little bit goes off the top, usually less than 2%, to pay for the fund manager. Load fees are funds you pay either at the front end or the back end to buy the stock. No load funds obviously have none of those. And commissions get paid to the person who sold you the mutual fund. They get a little bit of money for selling it. So front end loads are charged when you buy the fund. Back end loads are charged when you sell the fund or when you cash out. And so the cheapest funds tend to be no load funds. Those tend to be maybe the better ones to get. So there's three classes of shares, and it's really explained well in your book, and you should be reading the book as well as the lecture is just kind of designed to hit some highlights. But the share classes really aren't that important, but Class A funds generally have fairly small fees. Class B funds, the fees tend to be a little bit more, but a lot of times the Class B funds get converted to Class A funds after a certain period of time. So if you hold on to the fund for, say, more than 7 years, they get converted to Class A funds and you don't have the fees, or you have fewer fees. In Class C funds, there's an annual fee for those. So how to buy a mutual fund? Okay. Number one, research the funds. Everyone, just like a stock company that sells stock puts out an annual report that's usually posted on the website, each fund has what's called a prospectus. And Morningstar does a good job of telling you the style and does it invest in large, medium, or small companies. We're going to be looking at that here in a bit. Does it focus on value? Is it growth? Or does it focus on a blend? You can look at how it's done. And what is the turnover? Does it buy and sell stocks a lot? The higher the turnover, the more the transaction fees, so the more kind of dead money you're going to have, but also the potential for greater growth. So try to find one that's a no-load fund, so you don't have to pay fees when you buy it or when you sell it. Where do you buy mutual funds? You can buy them direct from the company, and I'm going to go to one here really quickly to show you. E-Trade, TD Ameritrade, or discount houses. They're not going to give you a whole lot of front-end management, but they do sell you mutual funds at a pretty low cost. through financial planners like Edward Jones or Charles Schwab, through your retirement. This is how most of us are invested in mutual funds, is through our 401ks, our retirement accounts. IRAs, 401ks are both heavily invested in mutual funds, and obviously banks and insurance companies as well. So what I'm going to do here is I'm going to go to a website and look at mutual fund research, and unfortunately the screen's not really allowing me to put things where I want to here. So let me kind of see what I can do as far as using this mutual fund evaluator. One thing you're coming to here, and it's at fidelity.com, and you can just Google the Fidelity Fund Screener. And the key here is you can pick between different types of asset classes. So allocation are kind of your primary funds. Alternative, these are high risk ones. Commodities, same thing, high risk. Commodities are buying things like corn and soybeans and wheat. International, a little bit higher risk than your general allocation. Money markets, very, very low risk. And municipal bonds, same thing, low risk because they're bond. Equity funds generally are invested in certain types of funds like sector equity here. Taxable bonds, those are U.S. bonds. Those are generally, these are actually corporate bonds. And finally, U.S. equities, which are U.S. bonds. They generally carry with them fairly low risk. But with that, you have a little bit less return. So I'm going to go with allocation stocks here. And one thing you can look at is, okay, it's 2020 now and you're your teens, so you're probably looking at retiring in 2060 or later. So I'm going to pick things with a target date of 2060 plus. And I'm going to also pick no load funds and see what we got here. Here's my results. And they should come up here and they'll be on our screen so that we can see them here. And so there's a whole bunch of funds. And one thing we can see here is, okay, here's how they've done this year. And obviously things are not very good because the market has been crashing here of late. And so what we see here is I've got this index fund that, okay, so what's an index fund going to do? It's going to follow certain stock indexes. And so there's a whole bunch of different types of funds here. We're going to look at this one here. Year to date, not doing too well, right? But here's the 3 and 5 year performances for these stocks. Here's the expense ratios. Notice here, your expense ratio is fairly low, okay? And then I can look at Morningstar, which is a rating service, rates how they're doing. And so you can see this is a 4-star fund. So we think that's going to be pretty good. What is the risk? Okay, we're looking here. This is a medium risk fund. All 3 of these Fidelity funds are medium risk. And so we can also look at the rankings here of how they're rated. And obviously, you know, how Morningstar has this rated as a 4-star fund. And so we'll go ahead and click on this Fidelity Freedom Index 2060 fund and see what it looks like. And right now, hasn't been doing good. But here's the performance over the last few years. And you can kind of see here it's been going down, but the trend line has been to go up. Okay, so here's the expectation. One thing you can see here, and let me drag this over here, asset allocations. Half of it, a little bit more than half, is domestic, which is U.S. stocks, international stocks, 7% in bonds, and then 3.24% in the money market. And so one thing that these are here is basically what we refer to as a mutual fund finder, and that gives you a little bit of an idea of what they look like. So we'll do some things where we maybe look at mutual funds this week. I'm not going to pile a ton of assignments on you because you have both your stock project to wrap up as well as your critical thinking assignment part 4. So I'm not going to really pile a lot on with mutual funds. We'll do a lot more with stocks next week. So hope you enjoyed our conversation. And if you have any questions, as always, hit the Q&A on our website or on Canvas, or shoot me an email, or we'll do the Flipgrid as well, and I'll be happy to answer your questions on that. Flipgrid.com/SmithVU. Thanks a lot. Have a good week.